Now we're going to finish up short exercise 17.9, measuring profitability. So requirement 4, compute the rate of return on common stockholders' equity for 2016. Now here's some abbreviations we need to know. AVG common SE stands for average common stockholders' equity. And then if there is a number with a 0, do put a 0 in there. And then once we convert it to a decimal, once we convert it to a percentage by multiplying by 100, we need to round to 1 decimal. So the formula for rate of return on common stockholders' equity, the two things on top deal with the return portion. So what do common stockholders get in return for owning the stock? They get, in theory, the net income. But what do they not get? We're going to have to subtract something, and that something is we need to subtract the preferred dividends. And then we divide by average common stockholders' equity. So the first thing we need is the net income. So we open up our income statement. Net income is $29 million. Now we need to find out if we have preferred stock. If so, we have to calculate the preferred dividends. Let's open up our balance sheet. In the equity section, our stock would be listed, and preferred stock would be listed first, but common stock is listed first. Therefore, this company has no preferred stock. So therefore, they have no preferred dividends. And then we need to divide by average common stockholders' equity. Well, if the company had a preferred stock, the way we would calculate equity is you take total equity and you would subtract the preferred equity. But this company has no preferred stock, so all we have to do is figure out the average of our equity, total equity. So we need to average 46,100,000 and 31,500,000. So this is what our formula is going to look like: 29 million minus 0. And then we have our beginning and ending equity divided by 2 to get an average of 38,800,000. So average common equity is 38,800,000. And then when we do the math, we get 0.74742. We need to multiply that by 100 to convert it to a percentage. So that's 74.742. But our rules say to round to 1 decimal place. So that becomes 74.7%. Okay, now we're going to look at these returns and see if they're good or bad. So assume the following industry averages. Profit margin is 22.8. Our profit margin, wow, it's 50.7, more than double. Rate of return on assets is 10.3. Our rate of return on assets is astronomically high, 42.8. So that's good. Asset turnover ratio is 0.54. Ours is 0.82. Remember, this means we're generating our assets. For every dollar of assets, we're generating 82 cents of sales. And ours is getting close to doubling that. So that's really good. Rate of return on common stockholders' equity for the industry average is 10.3. Ours is crazy high at 74.7. These are so high that I would probably go back and double check our numbers to see if we did them correctly. So these are strong, considering that average companies present much lower rates of return.